Good afternoon, and welcome to the Michigan State Medical Society's Tele-Town Hall on COVID-19. Today's topic is Leading Through Crisis, Financial Guidance and Strategies. My name is Rebecca Blake, and I am the Senior Director of Healthcare Delivery and Education for MSMS. And it is my privilege to introduce Nathan Mercereau. Nathan is CEO and President of Planning Alternatives, an independent wealth management firm in Bloomfield Hills, Michigan, with over $1 billion in assets under management. As a certified financial planner, Nathan provides comprehensive wealth management solutions for clients focusing on achieving and maintaining financial independence. Nathan will begin with a presentation, and then we will take a few questions from the chat box and from those that were submitted beforehand. Please feel free to submit those at any time during his presentation. Please note that this is being recorded and will be available for viewing after the program. Nathan, welcome.
Thank you, Rebecca, and hello to everyone. Thank you for joining us today. There's a number of things going on in the world of finance, and I want to share a few observations and most specifically some takeaways that you can apply to your personal situation. Certainly the medical world and community has been disrupted during this pandemic. And at the same time, there's been a number of tax law changes, stimulus programs, adjustments that all of us have had to make. And I hope that you can find some takeaway value that you can apply into your situation at the end of our presentation. So we're going to look at a few indicators that are on our dashboard and would encourage you to tune into as we navigate this crisis. And we'll talk about, as I mentioned, some next steps for you to apply into your situation. So let's go to the next slide. And one of the questions that I get frequently is, what's going on in the world of investing with the stock market while all of these negative things are in play? So we started with the coronavirus being announced, and the financial markets reached their peak earlier this year on February 19th, and then precipitously declined to their low of March 23rd. And that was the most rapid decline in the US stock market's history to what's called a bear market, when we decline significantly beyond a 20% threshold. Since March, there's been a significant increase in the stock market. And in fact, if we look at the financial markets today, the Dow, which is 30 of the largest US companies in the US, is down 10%. The S&P 500, 500 of the largest companies in the US, is down 5.5%. But surprisingly, there's some areas of the market that are positive for the year. The NASDAQ, which is a collection of technology companies, it's actually up over 10% for the year. Bonds through the aggregate bond market index is up almost 6% for the year. So there's a number of things that are going into play as we navigate this crisis. And it's hard to comprehend sometimes when you see a headline such as retail sales or what's going on with unemployment. Today we received numbers to confirm that there was about 1.48 million of initial unemployment claims that are in our unemployment system, and we're still at about a 20 million continuing unemployment claim rate. So we've had a significant spike in unemployment. Michigan has been hit especially hard, and we're all navigating this in different ways, and either personally or with family or connections. So while these things are going on, including being in a recession, we're actually seeing a stock market that has rebounded over 40% since its March 23rd low. And a lot of that is based upon the action of the government through fiscal policy, through monetary policy, and basically providing a net of support around a lot of institutions and really the ecostructure of our financial world. So if we dive into a few of the indicators that are worth noting, if we look at the next slide, we'll find that unemployment has been a key trend that we're keeping an eye on. And we're at a national rate of 13.3%. Nationally, the Department of Labor announces these numbers on a monthly basis. In terms of the rate on a weekly basis, they'll provide the unemployment claim status. So we're looking at trends around what is happening with the unemployment rate, and because that's a key element in forecasting recovery. Our base case is that we will recover. And in the short term, it's hard to know, certainly on a day-to-day, week-to-week, or month-to-month basis, how it all transpires. But from an overall direction, we believe that the unemployment rate will decline, and probably based upon some various data sources that we use, are just under 10% by the end of the year, which is what the Federal Reserve had mentioned a couple weeks ago. Many people see that it's going to be a long road to recovery. And in fact, it could take 2 years before we get back to the place where unemployment was near where it was before the virus hit. So that's a key indicator to keep tracking. We call it a lagging indicator. It's looking back, but those continuing unemployment claims are the key data point to consider. If we go to the next slide, we'll see that commodities, this is the price of oil. And looking back since the beginning of the year, you can see that there was a decline in oil, and around the April 20th or so, oil actually was negative. So how can that be? So if you look at that deep drop in the price of oil, it went down to, it was traded at actually negative $37 a barrel, and that was unprecedented. So another action that we're observing that just is head scratching at times, but as all commodities are, it's based upon, the price is based upon supply and demand. And with Russia and the Saudis just flooding the market with oil, there were no buyers, and that's what drove the price down. We are seeing oil stabilize more. You'll see that translate to the gas pump as you get ready for some travel this summer, and it will probably stabilize as our outlook, and likely creep up as recovery and demand comes into play. Our next slide, we're looking at government debt. So all of this is being financed, the crisis steps are being financed by the federal government, and not only the US government, but governments around the world. And if we look at this chart on the red line, it's showing that after March, there was a significant spike up. The middle of the chart, we were at about 23.5 trillion of US debt. This is the total of all the debt that the government has issued through the Treasury. And since the end of March, which is when the CARES Act was announced, and that was the stimulus program that provided relief. You may be familiar with things like PPP loans and different elements of relief that are provided. And that debt has increased dramatically, so that we're in the 26 plus million range, and that's just been in a few short months. So the action of the government is really what has created buoyancy in the economy, and that is going to continue in terms of their commitment to do whatever it takes to get us through this. And then if we look at the next chart, which is the S&P 500, the index that I mentioned, you can see on the top part of this graph, the decline since March 19th to the low, just over 2,200 in the S&P on March 23rd, and then a decline ever since. And at the bottom of this chart are what's called volume trends, the level of activity that's going on in the financial markets from a trading standpoint, the level of buying and selling. And you can see an accelerated rate of buying and selling as the financial markets declined through March, and then it kind of leveled off. And on the far right, there was a options contract expiration date last Friday, which led to a big spike in volume. But there's also been an interesting trend, and you may have heard about day trading. Day trading has appeared, and it's reappeared similar to how it was in the late 90s. In fact, there's a man called Dave Portnoy, who is better known as Barstool Dave. He's quite famous in the betting community, and he has decided to take stock investing as his hobby while he's been in quarantine. He has had a massive following, and more people are day trading than ever before, thanks to his influence, and also thanks to no commission or trading costs by many brokerage firms as they try to promote people. All of this is, in my view, not a good sign, because when you create a lot of activity in the middle of crisis, it can really cost you personally as it relates to being on track for your long-term goals. And while it feels uncomfortable to see financial markets go down, many times having the patience, the fortitude, the discipline, and having an effective strategy to navigate them is the key. Fidelity recently released a study that identified in this time period between mid-March to mid-May, almost a third of their customers between the ages of 65 and 70 got out of stocks completely. And that's unfortunate, because as we've seen this recovery take place, you may be in a position where you're wondering, do I stay in stocks? I got out of stocks, do I get back? We can talk about that a little bit more as we continue. If we look at the next slide, we'll see there's a couple things that I want to encourage you to consider. You may have had a career or practice disruption and be at a point where you need to reset your expectations. That's a very unfortunate thing for many physicians, many in the medical community who have had, who've been directly impacted by this crisis in their personal finances. And that's what I focus on with our clients, with our team. We have a team of 25 people that are supporting our clients to really focus on having a personal financial plan to help you navigate through the uncertainty that we're in, making sure that you're capitalizing on opportunities and also avoiding and minimizing risk where possible. So if we look at the next slide, we've actually outlined a 10-step program for you to use as you think about your personal finances. So there's a lot going on in the world that we can't control. Building a personal financial plan is looking at the things that you can control and having a strategy and a game plan that's aligned to your best interest. So number one, cash flow is king. And as you think about what's going on in your personal economy, making sure that you have appropriate cash reserves in place and access to capital. Well, what's that mean? It could be lines of credit. It could be what are called margin loans. It could be different areas of the government assistance programs that are available. So look to optimize all the various pieces of your financial life so that cash flow and cash projections are very clear for you. We recommend that you identify time periods between short, intermediate, and long-term time periods. Depending on your situation, your short term might be the next 30 days, might be the rest of the year, might be the next year. So assess your situation and break it down into these 3 time frames so that you can start to map certain strategies and certain allocations of funds to the goals that you have. I mentioned capitalizing and leveraging all the government assistance programs. Probably the PPP loan program is the most widely available and applicable program. And I know there's been previous webinar conversations about this. If you have a practice, you're hopefully back into some sort of flow of getting things up and running. But there's actually been some new adjustments to the PPP program as of a week and a half ago that gives a little bit more flexibility around how you allocate the funds, whether it's directly for labor costs or other expenses. And it gives you a little bit more time to either pay back the program or have an evaluation period before you request forgiveness. So there's many things that are moving right now in the world of finance. Just 2 days ago, there was updated guidance around people taking required minimum distributions. So that applies to anyone over 70 and a half that are withdrawing from retirement accounts. It also applies to beneficiaries that are receiving annual payments as they receive that from someone who left them an inheritance or a retirement program. So make sure that you're in tune with all of these programs, and what is the advice that we provide is to really focus on that personal aspect of how all of this applies to you. Otherwise, the information is vast and it's not digestible because it applies in different ways to different people. Number 4, reviewing your portfolio risk and asset allocation. That's probably the most important thing to do as it relates to your investment portfolio. Many times when financial markets go down, we want to protect what we have, and the instinct is to stop the decline by selling things and getting out of the most risky parts of the market, and that's been the stock market for sure. But asset allocation is about not putting all your eggs in one basket, but spreading your investments out into different categories, different types of investments. And what that means is, in the largest sense or high level sense, is have stocks and have bonds, have cash. Those are the 3 main categories of investing. And you want to have a portfolio that is aligned for your risk. A lot of people instinctively, if they see a market decline, want to do something with everything. But the reality is that you're not going to use all your money in the next 12 months, even if you're retired now or considering retiring. There'll be time periods over which you use your funds, and you want to typically have more conservative allocations for the funds that you're using in the shorter term, and you can potentially afford more aggressive allocations for longer term funds. So a very important element to consider. And in the midst of all this volatility, there's opportunity. One is to rebalance your portfolio. There will be things that have increased, and there are things that have decreased. And rebalancing means trimming back some of the areas that have increased and investing into those areas that are down but expected to appreciate. Another aspect is what's called tax loss harvesting. You may have investments that are at a loss. You can sell those to capture that loss on your tax return, your personal tax return for this year, and replace them with a similar investment if you want to stay invested, or if you just want to take that loss, hold the cash on the sidelines for 31 days and then repurchase the investment. That will allow you to capture that loss. That's point 6 is an important one to be aware of, because the tax loss harvesting rules apply to the security 31 days before you're selling it and 31 days after the point of sale. So you need to look both ways on your transaction calendar to make sure that all your transactions are aligned so you can fully capture that tax loss. Creating a plan, working with your team of professionals, it's really important during this time to communicate, to get feedback, to stay engaged. And that's the benefit of great webinars like this that MSMS has been hosting to provide you real-time feedback. And then finally, staying disciplined, sticking to strategy. And there are opportunities that are out there from an investment standpoint, so to be aware of those. But everything needs to be in a game plan that's in your best interest. Encourage you not to be tempted by products that might be pushed during this time out of concern for fear, and make sure that you're doing your homework. Make sure that you're sticking to a clear plan, working with your professionals that are looking out for your best interest and applying that on an ongoing basis. So the next slide, as I wrap up my thoughts, encourage you to map out a 30, 60, and 90-day action plan. As part of our giving back as a firm, we're offering a complimentary consultation, 1 hour, no cost, no agenda except to listen to what your needs are. We've worked with a number of physicians. We've had a partnership with MSMS over the years. So it's been something that's very important to us, is to be able to give back to people as they need it going through this crisis. And finally, personal finances sometimes gets put on the back shelf. Encourage you to keep that front and center. I know you have a lot going on in your life, but make those personal decisions a priority and start with a game plan and an action plan that begins right away.
Okay, a couple questions have come in while you're presenting, Nathan. The first one is, and you mentioned this a couple different times, but should I get out of stocks at this point?
That's a question on a lot of people's minds, because as the market has recovered from its March 23rd low, people are asking, themselves, should I just hop off the train here because I didn't enjoy the ride that I just experienced, and I don't want it to happen again, and I want to make sure that I'm protecting myself during this time. I would say the first point is to look at your risk level that you have with your investments and also your risk tolerance. Now, what we find is that most people take excessive risk in their investing because maybe they're impatient, maybe they want to see more gains. And in 2019, we had a very strong year in the financial markets, and it's tempting to add more risk because you want to see things increase. The unfortunate thing is when we experience declines, that risk will be amplified on the downside. But it's really important to be able to navigate volatility. And in general, we would not recommend departing from stocks, but it may make sense to adjust your risk level depending on where you're at. If you have been quite aggressive, it might make sense to become a little bit more conservative. And if you think of simply a scale of 1 to 10, 10 being the most aggressive investments, maybe you're 100% in stocks. If you're at a 10, it may make sense to come down the scale a little bit. But in general, we find that the biggest gains in the market happen after some of the steepest declines, and you want to be really in the game to benefit from that. Warren Buffett said, be greedy when others are fearful, and fearful when others are greedy. And that can be good advice to apply, especially during challenging times like we have.
Absolutely, thank you. One of your economic indicators was the unemployment rate. And you had mentioned that it was predicted to bump down from its current rate to about 10% by year end. We all know that Michigan has a higher than average unemployment rate. I think last week I saw it was maybe number 2, second state in the country. Do you think that will take that's accurate for Michigan, or do you think it will take us a little bit longer because of where we started at?
Great question. I do see Michigan taking much longer. The unemployment rate is in fact much higher, and the national rate is estimated to be under 10% by the end of the year, according to the Federal Reserve. There's a lot of debate among economists about what the Michigan rate might end up, but it'll definitely be in the teens, and it will really depend on the recovery that happens over the next 6 months. One of the challenges going to be as well is the state budgets are going to be completely, they need to be adjusted. So the revenue is declining, the budgets have been set, they need to be reset. That's going to create displacement. So when you have such gapping budget deficits, when it comes down to the math, you either increase revenue, which at the state level would be through taxation, or you decrease expenses, which at the state level would mean cutting services. So I believe that process will really exacerbate the timeline because it's going to take much longer for states to recover through this, which makes it even more important to have a personal plan and assessment of how to navigate this.
Great, thank you. When and why is the market going to have another major correction?
Well, if I knew that, that would be, yeah, I don't know that. No one knows that. So one of the things that we look at from market trend standpoints are what's called valuation. And that's the price of the value of the companies that are producing profits and revenues. So important to realize about the market is that the market is always looking forward 9 months, 12 months, 18 months down the road. So as we hear about these negative things happening, you might hear maybe unemployment rates increase in the coming months. We don't know. Maybe a second wave with the virus creates more disruption, and that creates challenges. The markets are looking beyond that typically. And as we see recovery in the market, it's being fueled by, one, expectations of an economic recovery, and two, and I think it's in the short term the most influential, the action of the government to provide stimulus and support in all areas of many areas of the financial ecosystem. So when the market will correct again or crash, we don't know. And that's why it's important to be vigilant, and you cannot time the market. Our saying is time in the market is how you make money, even if you have to endure volatility. But timing the market is one of the most challenging, and in my opinion, it's an unsustainable strategy, because if you time when to get out, you have to make a harder decision, which is when to get back in. And in my experience, in the 25 plus years I've been doing this, I haven't seen anyone do it, and doesn't mean it can't be done. But for an investor that has a timeline broken down into those short, intermediate, and long-term timeframes, having a diversified approach, low-cost investments, tax efficiency in what you have, spread out your risk, and have your risk aligned to your timeline is what we view as the best strategy to achieve the financial goals that you deem important.
Thank you. Another one on the unemployment rate. How is the U.S. unemployment rate comparing to Europe or other countries? Has their unemployment rate increased as the COVID numbers have decreased? And can that provide us with a little optimism as we're moving through this?
Great question. What we're seeing, and this is really interesting, and I believe a bright spot that will create some optimism, is that we're tracking data from other countries, Europe, China, and we're seeing some positive things developing. So the unemployment rates are declining in those countries, and it's based upon what we call high frequency data that we're tuned into. So things like how many open table restaurant reservations are being made? How many people are on subways? Does that show that there's a return of commuter traffic? Air pollution actually is an interesting data point. One of the benefits to our Earth during this quarantine is that Mother Nature was able to get a breath of fresh air. But as people return more to their employment activity, there's a huge ripple effect. So countries around the world are experiencing some lower unemployment rates. They're experiencing some recovery in their economic data. Interestingly, it's the Americas that are struggling on those two fronts right now, and we are delayed relative to our global peers around a higher unemployment rate and just some slower economic recovery steps because of the quarantine restrictions.
Thank you. There's a couple questions on 401ks, and I might ask them together. Should I continue to invest in my 401k if possible with declining revenue? And then with the current situation, are international funds as a part of a 401k considered a higher risk than they were even a couple months ago? Would it be wise to restructure or rebalance a portfolio to remove the international funds from these?
So the first part of the question is, should I add to my 401k? And that is based upon your personal situation. So if you really find yourself in a tight cash flow situation, it may make sense to lower or discontinue the 401k savings simply for the purpose of creating the cash that you need. That prevents you from having to withdraw from the 401k as your cash reserve. So assuming that that's not the case, and looking at the question through the lens of, is it a good place to invest considering all the moving parts of the world? The answer is yes, because A, you're getting an instant return on your tax return, on tax savings. Depending on your total income, any dollar that you put into your 401k is going to save you money on your taxes. And this year certainly has had a lot of change in the tax code and timing, and I know you had a separate webinar on that. As it relates to the types of investments, specifically international, we actually believe that international is one of the areas that represent opportunity. And if you look at, I don't have the chart today, but there's certain divergence between different types of investing. One is the divergence between international and domestic investing. Another is the divergence between what's called growth investing, companies that appreciate quickly, versus value investing, companies with strong balance sheets that produce dividends. And there's clearly a lot of attractiveness in the international market. If you look at the international markets relative to the domestic markets now, they're lower. And that doesn't mean that you should eliminate that from your portfolio. In fact, it may indicate an opportunity. But once again, your investing should be driven by your overall risk allocation, the diversification into various different asset classes. But I would not be inclined to eliminate international from that mix.
Thank you. Another one of the economic indicators that you talked about was the debt. What does this mean to their future or their retirement?
That's a great question. It's kind of like, how, I'm glad we're making it through this from a debt servicing standpoint so that we can continue moving forward, but what's the cost of this? And debt's very interesting because what's happening is that the Treasury is issuing bills, bonds, and notes, and the Federal Reserve is purchasing these. So the government's issuing and purchasing the debt at the same time, which in effect is giving a little bit of relief. Although we see these numbers, it's not a catastrophic action, I guess, is my main point, because the Federal Reserve will take that debt that they purchase and then redistribute it through PPP loans or stimulus checks or various programs. Sometimes they're working with different industries to support them and setting up structures so that the debt can be paid back, or some sort of benefit that may appear on the books of the Federal Reserve. So that's some of the mechanical things that's happening with debt. And granted, there still is foreign governments purchasing debt and different things going on. We call US debt the cleanest dirty shirt in the hamper, meaning it's not great to see this, but relative to other countries, the US debt structure is still manageable in our view, but yet in the short term. But our view is that there's going to be trade-offs in the long term. And some of those trade-offs, we believe, will be directly applied to the entitlement programs that we've come accustomed to, the Social Security, Medicare programs, as we have an aging population. But if we look to another country that has had to deal with issues that have really come to light in the US, it's Japan. And Japan has had massive debt for a number of years, aging population, some stagflation in their situation, in their economy as well. So while the debt is a big deal, it is the best or most appropriate action at this time. And then personally, as you think about this, once again, amplifies the reason to do personal planning. So you're not relying on entitlement programs as much as you might have planned for in the past.
Thank you. We know that many practices are struggling financially. What do I do if I have to reestablish my career path?
A lot of people are facing that, and in my opinion, it's important to, first of all, fully embrace reality. I find that many times we can, as individuals, ignore a situation or hope it goes away. And in my view, it's in your best interest to be radically open and transparent about what may happen. So on a very practical basis, spending a day, an evening, however long it takes, to outline scenarios that would apply to you. Let's say scenario 1, 2, or 3. Scenario 1 might be things recover and I'm back in order. Other scenarios might be that I have to find a different career track. That's where it starts, and creating a timeline for the next 6 months, the next 12 to 18 months, so that you can start to craft in your scenario some milestones that need to be examined. Then that serves as a chassis for you to see what may transpire. And from that point, it's important to start to work with your team of professionals to say, okay, under these scenarios, what are the financial implications? What are the legal implications? What are the tax implications? If I do need to go to a different career or pivot to a different path, what resources will I need? Will I need more to take from my personal funds? Will I need to source fund from various other means? So that conversation and running through those scenarios is, I believe, the most helpful next step.
Thank you. The last question that I have, unless anyone else wants to enter any into the chat box, is what are tax planning strategies I should consider for 2020?
A lot is changing in 2020, certainly with the extension of 2019 tax filing deadline to July 15th, and which has recently been put on the table or revisited, that maybe it's going to be moved to September. So the government is weighing what is the economic benefit of having an extension in the 2019 tax filing. So that's one part to be aware of. When you think about tax strategies, it's about capitalizing on what's available to you this tax year, this calendar year. So tax planning is now, it's not next year when you do your 2020 return. Looking on the investment side to harvest some tax losses, as I indicated before, would be a very practical step to look at. Looking to project what you see your income to be for 2020, and then seeing if there's other areas that would, many benefits or strategies also are completely dependent on your total income. So those could include charitable strategies, those could include retirement plan strategies, those could include gifting strategies to family members, or depending on the structure, if you have a practice, maybe you need to look at or opportunistically look at a transaction between parties, and while no one wants to have lower values than what you would hope for, there's ways to set up practice structures that can give you some time freedom if there's and contingency freedom if there's recovery. So work with your tax professional. I'm a financial advisor, certified financial planner, a fiduciary advisor. So we work with our tax professionals that our clients have, and it's really important to form that collaboration within your entire team.
Thank you. We have just one or two more, Nathan. I hope that's okay.
Sure.
We were in the process of rebuilding after a serious medical and employment crisis. How should we proceed now?
So when you think about personal finances, I go back to fully embracing reality and making sure that you're putting everything on the table that you have today. Creating a cash flow projection would be the next step to take with that, for example, 6 or 12 month period, and start to rebuild by making, when you rebuild, you've got so many competing objectives, and you've got to get the short term and traction in order so that you're earning income or that you're creating savings. So building a cash reserve would be a number one priority as you rebuild, because there's risk everywhere, but certainly when you're in rebuild mode, you're more vulnerable to those risks, can be more vulnerable to those risks. So setting money aside for different purposes, maybe think about them as buckets. You've got the bucket of your cash reserve. You might have a bucket where you need that money a year or two from now, and you want to make sure something's going there. And then you have the money for the longer term, say your retirement plan. It doesn't matter. It's not about the amount that goes into those buckets. What's important is that you activate each of those buckets. And even if the dollar amount is low, assuming that it's not compromising your cash reserve needs, do your best to fill those buckets, and then have a written plan about how recovery will map out, and share it with people that you trust and value their perspective, because they will, and find people that have been through this before. You're not alone. A lot of people have had to navigate recovery, and when you feel alone, you can end up acting alone, and that doesn't have to be the case at all. There's a great community of support. It's just a matter of taking the next step and reaching out.
Really great advice for finances and for life, Nathan. Thank you. Any closing remarks before we finish?
I want to thank everyone for attending and encourage you to keep moving forward, because there are challenges that we all face personally. There's certainly challenges in the world that we live, but we are amazing people, and we can get through this. And it's through prudent steps. It's through self-reflection. It's having a written plan. It's looking at all the pieces of your financial life and mapping them together to a plan that's in your best interest. So I want to encourage the audience to move in that direction. And please reach out if I or any member of our team can help. Take us up on our complimentary consultation. There's no cost or no strings attached. And if we have any input or resources, we're happy to share them with you.
Thank you, Nathan. Thank you for that informative discussion, and thank you for your time. And thank you all, the attendees, for participating in the town hall. Please visit the MSMS website. We've got 15 town halls recorded for free that you can watch at any point in time over the last 3 months, as well as many other COVID resources, both clinical and financial. So with that, I wish everyone a wonderful afternoon. Thank you.